I'm the SIG leader for the Portland AAI Income SIG chapter, and we want to welcome everybody. And of course, here's our usual disclaimer that we put up every time. Anything we say here should be taken with a grain of salt, and you should check with your experts and your financial advisors. So this is simply here for your information and information only. And then I just walk through these slides again. Everybody, I think, has seen them before, but I'll just quickly go through them and say, we're here primarily as income investors, where we preserve capital and we're looking for long-term buy and hold and a sustainable stream of income. So dividend stocks is probably one of the major things in our investment portfolio. And again, I put this up every time. We're kind of aiming at folks that are in the approaching retirement range and in the retirement years who are looking for a sustainable stream of income. Though probably later on in the summer, I hope to try to reach out to some folks that are in the building category, but we'll see about that later on. And let's see. This is our Google group. It's available for anybody who wants to post information there. We'll put the meeting announcements up there, and it's organized so that you can express yourself there. And it's a private group. It's just the AAI Income SIG members here in Portland, or we do reach beyond Portland. But mostly income-oriented folks. So it's friendly and then private, so to speak. And I just want to take a moment to recognize a bunch of people who, over the last 3 or 4 years, have made contributions, either in the terms of giving ideas or giving a talk or making a suggestion for future speakers. And so I've kind of listed those folks here. I'm sure I missed 1 or 2 or 3 or 4 of the folks that are not on this list, but anyhow, I just want to say thank you to everybody for your suggestions. That's what keeps this organization going, and so don't be bashful about suggesting ideas. You can post them to the Google group or just send it directly to me. I've got my email address listed below, so by all means, don't hesitate to send me your ideas. I'm always looking for projected speakers. Okay, Todd, you turn on your mic and tell us a little bit about what's going on with the meeting on the May 15th.
Yes, Andy, thank you very much. Can everybody hear me okay?
Yeah.
Okay, great. Yes, our next meeting will be on Saturday, May 15th, 9 a.m. in the morning. It will be video or webinar only. And we're excited about our speaker, Ian Abbott of Abacus Financial Services. And he's going to be presenting, discussing using inverse, as you can see, ETS to protect portfolios during market pullback. He's very knowledgeable about this subject. These inverse ETFs haven't been around that long, I think about 5 years or so. He's very knowledgeable on how to use them. And this is a way to hedge portfolios during pullbacks and bear markets. And so I'm eager to hear what he has to say. Given how far the markets have come here, I think we all should be thinking about ways that we can add some defensive characteristics to our equity portfolios. So I think it's going to be timely from that standpoint. And so hopefully we'll see all of you and many of the other AI members and attendees for our May 15th meeting at 9 a.m. You should be getting an invite to that if you haven't already with the link. And we'll be doing that just as we very similar to how we are here online only for this meeting. So
thanks, Todd. Todd is the president of the AAI chapter here in Portland, and does a spectacular job of recruiting speakers for us. And don't forget to sign up for that May 15th meeting.
Right, get that in your calendars now because it's going to sneak right up. I mean, it's less than 2 weeks away. Hard to believe, but it's going to be here very soon. So,
Okay.
To see you all there.
Okay, great. Thanks, Todd.
You bet.
Okay, just a quick reminder to everybody. You know, you can sign up for any of the meetings. There will be a notice that'll go out to the entire chapter for the meeting on the 15th, and there is a website that the chapter maintains. By the way, we do record the meetings, and this meeting will be recorded. And John Wong, our webmaster, will put it up there probably, oh, I don't know, maybe 3 or 4 days from now. It depends on how busy he is with other stuff. He still works for a living, so to speak. And so all the webinars are up there for your disposal. This happens to be a little dated, but still we have all the stuff up there. Okay, just a few rules on etiquette. Keep your microphone off so we don't hear barking dogs and spouses in the background and so forth. What I'll do is I'll ask Tom to kind of moderate the chat feature in Zoom, you know, we'll leave it up to Nick to decide how he wants to deal with that. Nick, when you get on, you can tell us a little bit about how you want to handle that. But Tom's available if needed. And I would suggest turning off your video because you might get a little better bandwidth in terms of the presentation by doing that. You don't really need to have it on. It's up to you. Okay, just a quick thing about the agenda. You know, here's our May 2nd meeting, and we're going to have Nick Ward talk to us a little bit about intelligent dividend investor. The June meeting is going to be at the same time, June 6th, and I'm going to ask Don Maurer and Peter Lang from the AAI Silicon Valley Computerized Investing chapter talk a little bit about how they use ETFs as a vehicle for generating income. And I think it's a very interesting approach and something that we should be aware of here. And so I'm kind of looking forward to that. I still have an open slot for July 11th. I'm looking for a speaker there. I'm trying to reach a guy that is with an outfit in Toronto that's doing some interesting stuff on income-oriented ETFs, but I haven't been able to connect up with him yet. And then, of course, we will probably skip for August, probably not have a meeting. I may be out of town, actually. We'll see if it goes according to plan. And then, of course, I'm always looking for somebody for the September 12th meeting. So kind of keep those dates open. And if you come across somebody who has a real income-oriented topic that you think might be a warrant for our group to listen to, by all means, please send me the information, and I'll try to get them to line them up to speak. Okay, I'm going to turn this over to our speaker, and he's editor-in-chief of the Intelligent Dividend Investor. And I will stop sharing and turn it over to you, Nick, and you can do your thing. Okay, I'm going to stop sharing here. And if you can step in there, can you do that?
Let's see, just click share. Let me know if it's working for you.
Aha, I see it. Yes, it's there.
Okay, awesome. Let me expand this. Okay, cool. Well, this is just my sort of, you know, my bio page on our website. I'll leave up while I speak through my introduction. So honored to be here. Thank you guys for having me. I come from Charlottesville, Virginia. So I just Googled it, about 2,800 miles away. So, you know, quite a long ways, but I have been to Portland. I've actually driven from here to there a couple of times. My wife used to be a professional runner. So, you know, I'm sure, as you all know, most of the large races are in the state of Oregon, and I have a big affinity for the Beaverton and the Eugene area. I like speaking to groups like this. I think it's really cool that you guys have this sort of retail oriented group here where you're able to share ideas and, come together. I think the sort of collective knowledge of a group is always better than the individual. And I consider myself to be, sort of an average Joe as well. I was a retail investor for a while before I became a professional analyst. I went to the University of Virginia. I studied English and studio art. So I don't have your, traditional sort of financial background from an educational standpoint. I got into portfolio management when I just realized that the professional, money managers that I had hired weren't doing a very good job. I wasn't pleased with their returns, with their trades, with their individual strategies. So I sort of just, went the DIY route and have since sort of really latched on to the dividend growth investing strategy. And that's obviously what the topic of today's talk will be about. So it seems like you guys are pretty knowledgeable, but just in case, this is a slide that I put together. This is my personal portfolio's results. The green columns here represent the dividend income that I've generated, each month dating back to the beginning of 2014. I did keep the numbers private just for my family's sake. But as you can see, the point is over time, when you pursue the dividend growth strategy, not only do you generate reliable income on a regular basis, but it actually grows and compounds over time due to the fact that the companies that you own raise their dividends every year. And then also you're able to reinvest those dividends either directly into the companies that pay them or selectively, into your favorite investments, each day, week, month, etc. And, those two things combined create a sort of compounding process that does get exponential. It does take time, but as you can see here, this is roughly a 6-7 year chart here. And you do see the red line, the trend line is starting to, curve up, in that exponential fashion. And this is, that red line is essentially what I'm basing my retirement plans off of and, eventual financial freedom. This isn't rocket science. This is something that I think anyone can do. It just takes discipline and patience primarily. So another reason that I wanted to mention this, you guys, Andy mentioned you guys are in either the retirement or the, preparing for retirement, nearing retirement stages in your investing life cycles. And one thing that, I really want to highlight with the dividend growth strategy is the fact that unlike, traditional sort of the 4% rule, the traditional retirement strategies that you hear about, where you liquidate assets every year to sort of pay your bills. And the idea is that, the market grows at a faster rate. So it is a sustainable process. The dividend growth investing strategy, you don't really ever have to liquidate anything. You're just relying, just on the yield that you generate every year. So you don't run the risk, at least in my opinion, and this helps me to sleep well at night, knowing that this is what I'm basing my personal retirement off of running the risk of, kind of outliving your money. We hear about technology and, we expect longer life cycles and lifespans moving forward. Maybe, you may be retired for decades. And so, if you're withdrawing 4% of your share count every year, that's a risk. You will eventually run out of assets. In the DGI strategy, you don't have to sell because every year your passive income should be growing at a rate that at least meets, but very likely exceeds inflation, by a wide margin. So not only are you protecting your invested capital, you're not kind of dipping into your principal, but your purchasing power of your passive income stream is actually expanding every single year. So, what inflation is expected to be, I think roughly 3% this year. Typically it's 2%. That's the Fed's target. And it's not very difficult at all to, generate annual dividend income increases that are, well above that rate. I am a younger man, obviously turned 31 this year. So my priority is more growth than yield at this point in time. In my personal portfolio, I'm compounding my income at a 12 to 15% annual clip. But my yield's only about 2%. Obviously, as your yield increases, your growth will decrease. That's just sort of the nature of the market as companies mature. But like I said, even at a 4, 5, and 6% yield, I still think it's possible to, grow your income at a, low to mid single digit clip on an annual basis. So I'll talk about, that and some of my favorite stocks here in a moment. But before I do, I do want to mention, obviously, and I'm sure you all are aware, but it would be a disservice not to say this, that no dividend is ever completely safe. They can be cut at any point in time. And, with that in mind, this isn't fixed income. There are risk involved. Equities are risk assets. However, I will transition slides here. This is the U.S. Dividend Champions List. This is run by a colleague of mine at Wide Moat Research. And this is a free service. So if you guys go to our website, widemoatresearch.com, you will be able to sign up for this with an email address. Many of you may be aware of it. Justin Law has been running this now for quite a long time. And David Fish was actually doing it before him. May he rest in peace. This is a chart that covers hundreds of companies. And I'm not going to go through all of them, obviously, but I do want to highlight that, the number of years. These are the champions. These have 25 consecutive years of dividend increases. And you will see, dozens and dozens of companies that have been growing their dividend at a very reliable rate for a very long time, through a myriad of economic environments, through recessions, through political change, through regulatory change, through, technological disruption. The point is that, while no dividend is safe, when you are partnering with, the highest quality names, the blue chip companies that have a long history of dividend growth, the past obviously doesn't predict the future, but, I think you can sleep pretty easily knowing that these management teams have put in, essentially just practices and policies and growth sort of engines in their companies that will allow them to continue to sustain their dividends over the long term. So this just goes to show there are quite a few companies that have been doing this. The champions list also has different subsets, companies with, 10 plus years, 20 plus years, et cetera. There's, I think, over 100 companies on this list. So dividend growth is it's a pretty wide amount of companies. They come from every sector, every industry. You can certainly maintain a disciplined portfolio while, still focusing entirely on dividend growth, or at least, mostly on dividend growth. Also, another one of my favorite things about this strategy is that by focusing on your passive income, which, it sounds like that's something that you all already do, you're able to sort of ignore the short-term volatility in the markets and, instead just have peace of mind that your dividend is growing. This is Fast Graphs. A colleague of mine, Chuck Carnival, owns and sort of has developed this site over the years. I think it's a wonderful tool for income-oriented investors to do fundamental analysis. And what I did is I sort of simplified the chart here. I took out a lot of the valuation metrics and just focused on the dividends, which is the white line here that you see, and the share price, which is the black line. And this is Realty Income. This is a REIT. It's my favorite REIT. It focuses on single tenant properties in the retail space. Pays a monthly dividend. It's been paying a monthly dividend for over 50 years consecutively. So amazing income-oriented company. But as you can see, there is quite a bit of share price volatility. And, that just happens with just about any company. A REIT is obviously going to be interest rate sensitive and sort of more economically sensitive than, a consumer package name or something like that. But the point is, this company has raised its dividend every year, since 1994 when it became public, and then dating back decades before then when it was a private company. And, a lot of investors, may get scared, may sell into weakness, may be concerned about, selling into strength, locking in profits. But to me, a lot of that is pretty meaningless. Over the long term, blue chip names like Realty Income do typically rise, as you see, from the left to the right. That is a pretty solid uptrend, even though there are some dips during, the time span. But the dividend is much more predictable. It's much more stable. And this is just a common theme amongst the blue chip dividend growth companies that people like me sort of spend our time analyzing and then owning in our personal portfolios. I am long Realty Income. I'll be long every stock that I talk today, just FYI. And I guess really quickly, I probably should have started with this, but I'm not a financial advisor. So sort of the first slide that Andy gave, I'm certainly not here giving advice. I'm just here sharing information for educational purposes only. But anyway, Just going through another chart, this is Johnson & Johnson, one of the only two AAA rated companies in the world. The other is Microsoft. If you were wondering, a wonderful company located up in the Pacific Northwest near you all. I'm sure you've heard of Johnson & Johnson. Like I said, this is less volatile than a realty income, but you still see dips here. There's still some volatility. There's still market timing involved with a lot of traders in this stock, but just look at this dividend line. It doesn't get much more predictable and reliable than that. This company, if we go to the CCC list, let me see here, where's Johnson & Johnson? It has increased its dividend for 58 consecutive years. I don't expect that to change anytime soon. As you can see here on the fast graphs, the expected dividend payout in 2021 is $4.20. It's expected to earn, nearly $10 a share. So, a very wide payout ratio there, very wide margin of safety. This is just, basically the perfect example of a dividend growth stock. You can ignore the price action volatility, a bunch of the headlines, whether or not there's going to be healthcare reform, whether or not, their talcum powder lawsuits are going to bankrupt the company. Instead of just, falling prey to those sort of fear and greed driven headlines, this is what I focus on. The white line here, I think, just paints a beautiful picture and shows, the reliability of dividend growth over time. Lastly, just another popular company, Coca-Cola, same thing. Very stable and steady white line here. That's the dividend. And we still have plenty of volatility, especially during recessions. I'm sure people were very scared. At the bottom of the last recession, same thing. The stock fell from roughly $60, down to below $40 at its trough during the COVID-19 sell-off. But as you can see, during both events, the company continues to raise its dividend year in and year out. So that does ignore the fundamentals, which I don't think is the sort of best idea as you're accumulating shares. But, the point there is that over time, your passive income is likely to increase, if you own these types of blue chip names. I'm going to get into a handful of companies that I've bought recently, just and kind of talk through my mindset there from a dividend growth standpoint and from a valuation standpoint. Here we have Lockheed Martin. As you see, the white line, very stable dividend growth. And if we look here, it's on the fast graph, generally double digit. It has slowed down in recent years to the high single digits. But over the long term, we're compounding our passive income here at a rate that is, roughly 3 to 4 times the rate of inflation. And then some years, obviously, much higher than that. Something that a lot of people struggle with that I talk to is buying into weakness. You talk about the fear of catching a falling knife, never knowing when it's going to end, not putting yourself at risk, et cetera, et cetera, et cetera. To me, I actually think, buying blue chips into weakness is kind of basically the simplest and easiest way to generate outsized returns in the market. I know that many of you may not be focused on total returns. You're probably just focused on your passive income, but it is a nice cherry on top to, generate market beating returns. And an easy way to do that is to buy names into weakness. And I recently bought, as you can see here at the end of January, Lockheed kind of dipped down to the 320 area. That is if we look at the 1-year chart, this was a bad year in 2020, and then kind of culminated with the presidential election. A lot of investors assumed that, with the sort of blue wave happening in Washington, D.C., that defense spending would likely fall in the coming years. I am of the belief that's not going to happen. Only time will tell. But the point of the story here is that this company, while growth is expected to slow, this are the analyst consensus, estimates moving forward. We do see, much slower growth than we've seen during the last 3 years. It's still positive. There's still a wide payout ratio. So it was very easy for me to buy down here. I bought at 328, so I didn't time the bottom perfectly. I was pretty close. That was at the time, we're talking about a 13 times multiple. With regard to earnings, we see that the stock's long-term average multiple is over 17 times. So that's what the blue line represents on this chart, if you guys aren't familiar with fast graphs. So it's easy for me to buy stocks into weakness, especially when they're trading below, those longer term average multiples, because I know that at the end of the day, I'm going to be paid while I wait, not only paid, but paid a rising dividend, while I wait for the fundamentals to sort of inspire investors to change their sentiment and for the stock to rally. This is L3 Harris Technologies. Another defense stock, another company that I bought back in January. We see it dip down here at 171.50, right around there. I think it went down in the 168 at its recent lows, but I was able to buy at 172. It was below average. This company has been growing its dividend at a phenomenal rate. We see, roughly 20% increases in the most recent years. And then early in 2021, L3 Harris gave another 20% increase. So, we're at that rate, I'm doubling my passive income, roughly every 3 years or something like that. If you do the rule of 72, it's very easy for me to buy blue chip dividend growth companies into weakness because I know that I have this reliable income coming in and this reliable dividend growth. Just a couple more examples of this happening. These are, another recent trade. Domino's Pizza recently fell below its long-term average. This is still a pretty expensive stock at roughly 27 times earnings. When I bought it, I was able to buy down at 330. So the Fast Graphs does these marks at the end of the month. So, if there's an intra-month low that's lower, it won't be totally accurate. They just kind of give long-term trajectory plans. So I bought at 330 and the stock's up at 422. That's wonderful, but I didn't know that was going to happen when I bought. Nobody can know the future, but what I did know was that this company pays a very safe dividend. We see its payout ratio is quite low with, the dividend this year expected to be at 376, roughly $13 in earnings. And we also see that this is a company that has very consistently grown its dividend at a roughly 20% clip. I expect that to continue moving forward. You do see this yield's quite low. As I said, I'm interested in growth. That yield may be too low for many people on this call, and that's totally fine. You have to target companies that meet your investment needs. But, the moral of the story is I was able to, lock in some pretty nice short-term gains kind of unexpectedly. It wasn't the point of the trade. The point was just to, safely buy a reliably growing dividend and to reap those long-term rewards. I did the same thing here. Home Depot, once again, traded down to fair value, roughly the 21 times, bought some shares at 255. I didn't expect it to go up to 323 in just a couple of months' time. I'm, very pleased that it did. But, the moral of the story is this is a wonderful dividend growth company. You do see it did freeze its dividend during the Great Recession, didn't cut it. That's a big distinction. If this company would have cut, I may not be interested in owning it, but it did. It maintained. It showed sort of, a defensive nature and a dedication towards its shareholder base. And then since then, we, as you can see here, just wonderful, wonderful double-digit annual growth. Now, with that being said, I want to get into a couple of my favorite ideas. Right now on the market. These are companies I've either been buying in my personal portfolio or for the Intelligent Dividend Investor portfolio. These both have buy ratings for that service. I obviously can't give you guys all those picks. It is a premium service, but I'm happy to give a couple here. These are also going to be a couple of higher yielding names, so they probably will fit, this typical type of investment strategy from this group as well. We have, first we have British American Tobacco. I know some people have qualms with owning, sin stocks or tobacco names, and I get that. If you don't feel comfortable with that from a sort of moralistic view, that's great. There's many, high quality dividend growth names in the market. But for me, I look at a stock that, we see a massive sell-off here in 2017, 2018, and the stock has essentially stagnated in the last couple of years. But during that period of time, the EPS continues to grow. There's been a flat year in 2018, but it was up 28% in 2017, 6% in 2019, 10% last year. We're expected a down year this year. The company is investing pretty heavily in sort of new age, non-cigarette related products. So this is expected to be an investment year, but analysts and the company itself does expect to continue to grow its EPS into the future. So to me, this just represents a bunch of fear. People are worried about the secular headwinds that tobacco faces, yet the fundamentals paint a different story. This company is still generating reliable income that translates into a reliable dividend yield. We do see a roughly 8% yield here on BTI today, but as you can see, there's still a pretty wide payout ratio. It's roughly 65%. That's the company's target rate. And I guess it is worth mentioning this company does operate in British pounds. It is not a US company, so there is some Forex concerns here But generally speaking, the pound and the dollar are not too volatile relative to one another. And at the end of the day, like I said, wide payout ratio, high yield, underpriced stock. I'm very happy, and I've been happy. I've been buying shares of this company to generate 8% a year as I wait for the sentiment to turn around. And I think this will happen. We have seen the sort of U.S. company Altria, another tobacco name. That company is up over 20% this year. So it was a very similar chart. It was low for a long time. I think this is a coiled spring developing. I don't know if it's ever going to trade back up to its long-term normal in the 13 times range, which, that would represent a share price of $66, dollars in a couple of years, roughly double the current share price. I'm not calling for that to happen, but I think that the current PDE ratio of roughly 8 times is just simply too low. You slap a 10 times multiple on this stock, you're talking about a $46 per share stock. That's a pretty hefty, price gain here, and you're still locking in this very high yield on cost. And moving on to Bristol Myers, which you'll see a very similar chart here. The share price has stagnated for a couple years now. There is a lot of healthcare sort of regulation fear here. There is also in the biopharma space, you're always going to have, loss of exclusivity and patent cliff concerns. However, while all these concerns have been happening, look what the company did from an operational standpoint. 41% EPS growth, 6%, 32, 18, 37, and this year it's expected to be at 16. So this company, the share price hasn't gone anywhere, if you go all the way back to 2013, but the fundamentals have essentially, quadrupled since then. So to me, we see the black line well below the blue line here. I don't think we're going to see $123 on BMY anytime soon, but I do think, once again, this is another coiled spring developing. It's been developing for a while. I've been bullish on this stock for a while. I have been buying shares as low as $40 recently, so I've still experienced nice gains, but my price target is in the $90 area, so I have a long way to go. But in the meantime, because of the company's reliably increasing dividend, the company's 3.1% dividend yield, it's very easy for me to just hold on to these shares and wait for, my perceived bullish turnaround to happen. I will note this line isn't quite as steep as many of the others that I've seen. For years and years, you see Bristol Myers was just essentially increasing 2% a year. They were doing that inflation matching increase just to sort of keep investors at bay and to maintain its annual streak. But I do want to highlight they made a big acquisition a couple years ago, acquiring Celgene, and in the 2 years since then, they've been much more generous. In 2019, management gave a 9.8% dividend increase, and then last year in 2020, it was an 8.9. So getting back to the growth, we see strong double-digit growth. It is expected to slow, but like I said, I don't need this company to grow fast when it's trading for 9 times earnings. I'm paying the S&P 500 is yielding 1.33% right now. So this yield is more than twice as high as the S&P 500's. The stock's valuation is very low. The S&P 500's forward PDE ratio right now is roughly 22 times. So we're talking less than half of the valuation, with very similar, growth prospects in the next 2 years. So I think this is just a perfect example of fear sort of impacting share prices and investor sentiment. And then an investor like me that is just focused on safe dividend income can feel comfortable buying these shares into weakness because of the reliably growing and the dividend payout ratio that we're going to receive. So that's basically the end of my presentation here. I think the plan is for some Q&A, which I'm very happy to do. I do want to note, Andy mentioned that I am the editor-in-chief of the Intelligent Dividend Investor newsletter. This is a monthly newsletter. You get weekly updates. There's, I think, 21 positions in the portfolio right now. In 2020, during the pandemic year, every single one of them increased their dividend. My focus is 100% on this dividend growth. The average yield of that portfolio is roughly 3%. So I think it probably meets, a lot of investors' needs. What we did is if you guys go to widemoatresearch.com /AAII for your group here, we will, you give us your email, we will send you a free edition of the newsletter. The new edition for May is actually coming out tomorrow. I think we're sending out April. But, that will, since you guys had me here, we're happy to give you guys a free edition to kind of let you take a look at the product to see if this is something that you're interested in long-term. And if so, it is a premium product at $79 a year. So that's something that you could pay for if you deem, that it would be a valuable resource to you. But with that sales pitch out of the way, I don't want to, get caught up too far on that. It is how I pay my bills. Let's get into some questions. I'm going to expand this chat here if I could figure out how, and take a look at the chat feature, or if Andy or one of your helpers can help me with some Q&A, that would be wonderful.
Yeah, Tom is designated to help with that. While you're doing that, what's the price for your subscription? Is it?
It's $79.99 a year.
Wow, it's a bargain.
Yeah, it's low priced. Last year I locked in 123% gain on an Apple position. So that, all you had to do was buy one share and you paid for it. Obviously I can't guarantee, I can't guarantee that moving forward, but we're up over 60% since inception. We beat the S&P last year. Kind of just in my opinion, if you focus on value and if you focus on quality, and then if you reinvest those dividends, you're putting yourself in a wonderful situation as far as total returns go. I am struggling with this. I'm sure you see me here. I can't figure out how to get the chat to come back up.
I'm happy to read those to you. Or
Sure.
if you go to the very bottom of the screen, you should have a little icon that says chat.
I can't. Oh, here's more. Oh, here we go. Here we go. Awesome. Okay.
Click on chat. That should display it to you. Or again, I'm happy to read them to you.
Yeah, I see it right here. So can you guys still see my screen, right?
Yeah, we do. Yeah.
Okay, awesome. So we have Jack Glasser here. It was the first question. Please repeat the website for these dividend stocks, which is free. I'll just go ahead. If you guys, if you go to Wide Moat Research, I'll just show it right here. This is our company. We focus on all sorts of dividend. We have REIT products, dividend investing products. My internet is slow. It was kind of founded by Brad Thomas. I don't know if you guys are aware of him. He's my colleague. I think he's presented to you all before.
Yeah, he has. He spoke to us last year. Yeah.
Awesome. Yeah, he just released a book. So he's got the top real estate here. He's trying to sell some books. And but anyway, if you guys scroll down, if you go to our products, or where is it? Products, research services here. And then we have our different products here. And then somewhere down here should be the Dividend Champions. At the bottom, the Dividend Champions, you subscribe for free. You put in your email, and then that will give you access to this very large spreadsheet, tons of information. The information I like best is the annual dividend increases. And then if you go to the next page, like I said, it shows you your growth, your fundamentals of dividend growth rates. There's everything a dividend growth investor would need is on this spreadsheet. So hopefully I didn't go too fast, but like I said, widemoatresearch.com, products, research services, scroll to the bottom, subscribe for free. There you go. Let's see. Are you worried about the changing? William Gregg says, are you worried about the changing dynamics in commercial real estate as it relates to realty income? Generally speaking, I'm not. I mean, there is obviously headwinds in the retail space. That's been going on for years with e-commerce kind of taking away share from the traditional brick and mortar retailers. However, I've spoken to Realty Income's CEO numerous times. Brad interviews him on a regular basis, and I like to kind of chime into those interviews. This company is so focused on kind of the traditional location. They're not just buying any buildings. They're buying buildings with, great traffic sort of dynamics and metrics. They partner with wonderful tenants. They just made an M&A deal last week. They bought Bear REIT, which not only expanded their portfolio, but diversified their portfolio and increased their exposure to investment grade tenants. So, there is obviously headwinds, and I'm only interested in buying the highest quality REIT names. I think Realty Income's portfolio is nice. I think it just got better. I love their fundamentals, and I love their focus on quality. If you go look at their, any of their financial reporting throughout the last year or so, you'll see that their rent collection data has increased just about every single month. So, they're doing better. They're kind of cutting the fat getting rid of their weaker tenants, replacing them with stronger tenants. I have a lot of confidence in Realty Income moving forward. Let's see here. Tom Gifford says, how to balance dividend growth versus dividend yield. To me, that basically, that's just a very individualized, question. That depends on your savings rate, your nest egg, what your expectations are for kind of your annual expenses in retirement, what's the sort of lifestyle you want to live. That basically, you divide those expenses by your nest egg, that comes up with the yield you need to generate. So, I'm sure all you guys are aware of how to do those basic calculations. And then I guess once you have that baseline yield that you need, what I would say to do and what I do personally is I would focus on the most growth that you can generate at that yield threshold. I like to focus on growth personally because to provide sustainably growing dividends, you have to produce sustainably growing fundamentals. Otherwise, it's just not possible. And then as fundamentals increase, as sales, as earnings, as cash flows, et cetera, so do share prices, generally speaking. So you're putting yourself in a situation not only to generate dividend growth, but to generate, capital gains as well. So like I said, this is a pretty generic question. It's hard to answer. This is obviously something like your financial advisor could help you with. But for me, I find the yield that I need, my target yield, and then I try to generate the most dividend growth that I can at that target yield. Jack Glasser says, can you give me the email address for the free issue of the Intelligent Dividend Investor? So that is widemoatresearch.com, and I'll type it up here for you. It's and then /AAII. And when you do that, you will get this, we created this kind of landing page for you guys. All you do is, you type your email in down here. That's my email. That's my wife's email. You type yours in. And as my technical team tells me that they will, send you a free copy of the newsletter if that happens. So if that doesn't happen, please, just go to widemoatresearch.com, and then we have at the bottom, you'll see our support. Just where is it? Somewhere down here. Contact us. Go to our support. Let them know that you were at this meeting, and we'll certainly help you out. I'm assuming that landing page works. It should. We built that this week, knowing that I had this presentation. Let's see. Do you time your purchases at all around dividend payment dates, or is that a factor you don't consider at all? For me, my main focus is valuation. So I'm trying to focus on quality and value. So I don't, really factor in ex-dividend dates and things like that too heftily. I have a long time before I retire. So if I miss out on a dividend payment or something, it's not the end of the world. All things being equal, I obviously do try to buy ahead of X dates so that I receive all of the dividend income that I can. But to me, looking at these fast graphs, where are we at here? This is Home Depot. I wasn't thinking about the dividend at all. I just saw that the valuation came down to a fair level. In my opinion, my price target was 255. The shocks fell to 255. So I bought it at 255. I felt good about it. Like I said, I had no idea this was going to happen. I'm happy that it did. I'm not thinking about selling the stock because, I expect the EPS and the dividend to continue to grow. So I'm just very happy to, buy at fair value or better, ideally better. The wider margin of safety you can get, the better your returns will be and the lower your risk will be. But, once I accumulate shares of a wonderful company like a Home Depot here, then I just sit back, hold it, and reinvest those dividends. Can you repeat the link to the free newsletter? Hopefully you got that again. Yeah, I know that these are old dated, so I will continue to scroll down this list and go through this again. Let's see. Are you concerned that the Biden administration may ban menthol cigarettes and that may hurt tobacco stocks? Obviously that's been a huge headline recently in the tobacco space. We've seen the talk about the menthol ban. We've seen a talk about increased cigarette tax to help sort of pay for all the stimulus and for some of the infrastructure spending. And we have seen, probably most notably, even more than menthol, is the proposal brought up. The Wall Street Journal reported that the Biden administration hopes to reduce nicotine in cigarettes to a non-addictive level. That long-term could theoretically hurt sales because, if less people are addicted, the fact that people are addicted to these products is kind of what helps them to maintain their pricing power. But it's not a huge concern for me for two reasons. First of all, Every analyst report that I've seen regarding these sort of legislative and political headwinds, these are going to take years to pass if they pass at all. There's not a, the tobacco space has been facing regulation for decades now, and they have a pretty good lobby. They have a lot of good lawyers. This, there's a freedom aspect to this. Should the government regulate, what a consumer can and cannot buy? There's obviously on the other side of that aisle, there's the healthcare argument. Those two things have been, at kind of, going back and forth for a while now. But the fact is any big regulation like this, it's going to take a while to get through Congress, and then it's going to go to the courts. It'll probably go to the Supreme Court. So in the short term, no, I'm not concerned. Longer term, it is a risk. However, Altria and British American Tobacco, the two tobacco names that I own, Philip Morris, I don't own it, but it's doing the same thing. These companies are working very hard to get away from cigarettes. They know that that's a secular growth headwind. So they're getting into heated tobacco. They're getting into e-vapor. They're getting into these devices that can give you nicotine through all sorts of different, deliveries, and can also get into like the sort of marijuana, CBD. Once that gets legalized, these devices will also allow users to use those types of products. So to me, that's the future. And, I think that the cash flows in the present will allow them to sort of bridge the gap to that future. I do think it's a great question, though, and it is a risk. And I think because of that, it's always very important to manage your single stock risk. I didn't really touch on that in the presentation. That's a kind of a different portfolio management discussion altogether. But, obviously figure out, what your risk tolerance is and don't go above it. I think BTI is incredibly cheap, but I'm not going to let it become too large of a position in my portfolio, even though I'm having a really hard time finding strong values in the market today. Just because I'm not, managing single stock risk is important to me. And I never want to put myself in a situation where, one missed, hypothesis or, just projection would put my portfolio and most importantly, my passive income stream at jeopardy. Let's see. Yes, that is the URL for the free edition of this newsletter. So at the bottom, scroll down, put your email here. Sorry, I guess that may be where some of the confusion is. From here, you can't see it. And I will address that with our team next time. Scroll down just a little bit, put your email in here, and you should get it. How do you feel about dividend ETFs? They are easy to deliver reasonable yield with reasonable growth. Yes, they are. And I think ETFs to me are a wonderful product. Probably for the masses. I'm assuming in this group, a lot of you guys are sort of do-it-yourself investors. And, my issue with ETFs is that you get the good with the bad. You get diversification, which is great, but that also means that, every time you buy one share of an ETF, you're buying within that basket of stocks that they own, overvalued stocks and undervalued stocks. You're owning stocks with wonderful dividend growth prospects, stocks with some shaky dividends and poor fundamentals. So, the ETF managers, those are automated, and I don't think they do a great job of, just kind of predicting dividend cuts and things like that. So to me, I don't buy ETFs because I don't want to own, the bad or the poor or the questionable stocks within them. I would rather, take the time and the energy to do the work and to pick the very best stocks. But with that being said, that does take time. It takes energy. You need a passion for the market. I do this full time. Obviously, you guys probably don't. Most people don't. I spend dozens of hours a week just reading reports. If you're not interested in doing that, which by all means, that makes a lot of sense to me. When I'm retired, I probably won't do that either. I'll be on a boat or surfing or doing something fun. You can just buy an ETF. And yes, there are dividend growth ETFs that do generate reliably increasing income. For me, in the accumulation phase and even in the retirement phase, depending on, like I said, your appetite for investing, I think you can generate better returns than what an ETF does. Hopefully that answered your question, Tom. Kathy K, what would trigger a sell? For me, that's pretty simple. A dividend freeze or dividend cut obviously triggers a sell because that, a cut is the antithesis to my strategy, which involves around compounding, growing dividends. I do sell things when I see fundamental changes. I do try to anticipate cuts. I've been able to do that pretty effectively. You can generally see when payout ratios are rising, when margins are falling, when debt is rising, when balance sheets are going, in the wrong way, credit ratings are falling, et cetera. It's you never know what the future holds. I have had a pretty good success rate at predicting dividend cuts. And so that is the main thing. I'm basically income oriented focused, even though I'm still in the accumulation phase, I'm focused on that income stream. So I don't focus too much on valuation for sales because, Visa, Nike, all these wonderful companies, Apple, they've looked, extraordinarily overvalued for several years now in many cases, yet they keep going higher. They keep producing wonderful growth. So once you own them at a good and reasonable price, my stance is just to hold them and benefit from their compounding, knowing all along, even if they experience a dip or a sell-off because of their high valuation, you're still going to get that growing dividend one way or the other. So that's kind of an example of me focusing on the dividend as opposed to focusing on the share price movement. Obviously I pay a lot of attention to value while I'm accumulating, but once I own something, so long as that dividend grows at a rate that I deem acceptable, I'm very happy to hold. Let's see here. Todd Blickenstaff says, some analysts believe that publicly traded REITs are currently more attractively priced versus private residential single-family homes in the current environment. What is your view? It depends on the REIT, obviously, but yeah, in general, I just prefer to own REITs as opposed to actually owning, the hard real estate myself because it's easier. I'm not a handyman. I don't really want to learn how to do that. I don't have the time to do it or to learn how to do it. I don't want to deal with tenants. I don't want to deal with the legal disputes. I don't want to pay taxes. I don't want to do all these things that, when I got in here early and a gentleman was talking about his rental house in Hawaii, quite jealous of that personally. However, I'm sure he can attest to this. There's generally a lot of work, or you have to pay a property manager to do it. So either way, it's either time or money. For me, I'd rather just own a REIT, let those professionals manage those properties and do all that for you. And, we talked about realty income. Most of the REITs that I own are triple net lease REITs, which means that those tenants, realty income owns the properties, yet in their lease agreements with tenants, their tenants have to pay taxes, they have to pay insurance, and they have to pay maintenance. So the triple net lease kind of business plan is essentially the highest margin business plan that you'll find in the market. I mean, there's some software names and stuff that have very asset light businesses that generate, very high margins. But when you pass all of those costs onto your tenants, and they're happy to pay them because they don't want to have to own the real estate themselves. Big companies don't want hard assets on their balance sheets a lot of the time. It's a lot of margins and it's just easier. So much of what I try to do when I'm thinking about investing is just create a stress-free, simple, easy environment. So, depending on your market, I'm sure there's, certain markets where it makes more sense to buy a hard asset like a house and rent it. Otherwise, it might be more of a REIT. That's probably pretty individualized. And I honestly have no idea what, the Portland area's real estate market is like. I know Seattle's, really hot right now, for instance. I've done a lot of work on them because I own Essex Property Trust, which owns houses in California and Seattle. I don't know much about Portland, so I can't really speak to your local market. But in general, I just say REITs are easier to own than properties, which is why I do them. Let's see, PJL. Excuse me, let me reposition myself here, says, what is the maximum but realistic yield threshold in your opinion? This obviously just depends on the fundamentals. So it's not a clear answer, but just generally speaking, I would say kind of that 6 to 7% range. There are high quality names in the REIT space, in the tobacco space, in the telecom space that pay that 6 to 7% range. AT&T comes to mind, a little risky, but I think the dividend's safe. WCP Carry, the tobacco names, like I said, I'm sure there's a dozen or so stocks that pay high yield. You have MLPs and stuff. Enbridge is a stock that I own and that I like that has, I think, roughly 7% yield. So, that's kind of for me where I generally see it happening up above that 7% threshold. Usually there's an issue, in a low interest rate market like we live in, investors aren't going to let a dividend yield get very high unless there's a concern that it's not safe. So the market's not always right. We see kind of accidentally priced yields all the time. That's kind of like a Jim Cramer quote. And that happens. But also, just you need to be very, laser focused on the fundamentals with specific regard to dividend safety. Do the cash flows cover the dividend? Are sales growing? Does management have, a plan to just maintain that sustainable dividend? Because, you'd never want to see a dividend cut. When those happen, share prices fall as well, kind of putting yourself in like a double whammy situation. So, like I said, generally speaking, 6 to 7% is kind of the max that I think is safe in most cases. Every now and then, back in March, there was companies with 10% yields that were safe just due to the irrational nature of that sell-off. But so I guess that's my answer. Kind of 4 to 5%. There's, there's 50 companies probably in that range that pay a very safe dividend and that sort of yield. So to me, that's like the sweet spot, but you can push it a little above that, if you're focused on the fundamentals. Let's see. The U.S. is but one market for BTI. They are worldwide and in markets that aren't fighting tobacco as much as the U.S. Do you concur? Yes. BTI is a global company. They sell, I think they're in 180 countries. I recently read their report. Don't hold that against me, but they're a global company, just like you said. And yes, you're right. Some of the sort of westernized developed nations have much more regulation in place than they do in the emerging markets, and BTI certainly benefits from that. There are Forex concerns and things like that in those markets, but in general, I really like the combination of Altria for domestic exposure to tobacco, to wine, to beer, and then I'm of the belief that cannabis will be legalized in the U.S. is probably in a lot of places because of governments need tax revenue, and cannabis certainly generates it. So once that happens, that'll be another market for these companies to get into, and that's why I like them over the longer term. John says, what is your opinion regarding telecom stocks? Oh, sorry, got another one. And that pay relatively high dividends. I own them. I like them. I own AT&T and Verizon. Those are obviously the two big names that, everybody in the U.S. is aware of. Their debt loads are, incredibly high right now. Both companies are selling off assets and, focusing on debt repayment. Their dividend growth prospects are very low because of this. AT&T froze its dividend, so they didn't raise it on their regularly scheduled basis in this year like they should have. That doesn't mean that they won't raise it, off schedule. But most of these companies have a given quarter every year where they increase it. AT&T did miss that, and they just maintain their dividend at an inline level. I still think it's safe. The payout ratios aren't terrible for either AT&T and Verizon. I don't expect a lot of dividend growth. These management teams are going to focus on debt reduction first and foremost. So there's a risk there. Of course, the 5G CapEx is very large. We saw both of those companies spend a lot of money at the Spectrum auction earlier in this year, but generally speaking, I think the dividend's safe. I own them. But there's, I do kind of cap those risk thresholds in my portfolio because, the cut risk with a name with a high debt load and with low growth is obviously much higher than it is on another company. Is owning utility stocks, Sean asked, the best suited to an investor in retirement? Well, I don't think best, that probably varies in person to person, portfolio, but I do obviously think utilities are known for their reliably increasing dividends. They're not fast growers generally, but they do, across the board, the highest quality ones generally do pay that annual increase that's above inflation. So it does meet my minimum threshold. Utilities are a little bit expensive right now, in my opinion. They've been that way for a while now because of the low interest rate environment. People are just piling into defensive stocks that pay yields. So I don't think there's a lot of great bargains, but I do think the yields are relatively safe. They're also kind of inflation protected, which is nice. Those regulated utilities are usually able to pass along cost associated with inflation to their customers and therefore generate, higher cash flows to pay a rising dividend, even in an inflationary environment. So I certainly think owning utilities makes sense, from a diversification standpoint. I own them as well. And, with, your question best, I certainly also don't think somebody should own like only utilities. Diversification is important. And the growth is obviously going to be low on the dividend stock. Let's see. PJL said, if the maximum dividend is 6 to 7%, does that mean that a good dividend portfolio can support 6% annual withdrawals growing at a rate of inflation, half as much as the 4% rule. Let's see, let me think. I'm a little confused. I guess when I think about a dividend growth portfolio, I don't think about withdrawals at all. I obviously, not everybody has enough money in their, as in their nest egg to support themselves in retirement purely through dividends. But to me, the idea is, if a 5, 6, 7% yield can support you, then you don't have to worry about withdrawals. You just have to collect those dividends and use those to, pay your bills and stuff. Let's see, with that being said, I guess, this question, if you need to withdraw something past what your portfolio generates from a yield perspective, yeah, I think having a higher yield a high safe yield, most importantly, would reduce, the amount that you have to withdraw because your income is covering, hopefully a large percentage of your annual expenses. So to me, if you have to withdraw anything, lower the better, in my opinion, just because, like I said, I stay up at night worried about outliving money in retirement for myself, for subscribers, things like that. To me, focusing on the income and relying on the passive income is the best way to do that. But I do understand that, that does require a lot of money in certain cases, especially if you live in a high cost of living area. Let's see. Do you have separate portfolio for just growth, non-dividend securities? I don't. Let's see, something I can pull this up for you guys. I write these Dividend Kings. This is another premium service that we offer on Seeking Alpha. This has a ton of tools and a bunch of portfolios. Where is it? April, somewhere down here. Every month I write an update for subscribers that, highlights the trades I make in the month, highlights more portfolio, et cetera, et cetera, et cetera. This is kind of privileged information, so sorry for scrolling so fast, but I will show you what I do. I show people my portfolio. This is my real money portfolio. I don't show the share count, like I said, to protect my family's privacy, but I do show my weightings. But more importantly, I showed the different breakdowns. So my core dividend growth, you'll see, is roughly 47%. Apple is my biggest position by far. Most of my positions are in this kind of 1% to 2% range. Apple's just been such a wonderful company for me, and I've trimmed it a few times, but it just keeps growing and growing. So it is what it is. But as you'll see here, high yield, it's roughly 14% of mine. These will obviously vary from person to person, depending on your financial situation. High dividend growth, these are companies that I expect to generate double dividend growth, double digit, percentage annual on a regular basis moving forward, roughly 18%. You'll see my non-dividend is roughly 11% of my portfolio. I own Amazon, Alphabet, Facebook, some disruptive growth ETFs. These are the only ETFs that I own. And that's just simply because I don't know how to evaluate these types of companies. So I'm happy to pay a manager to do so for me. But I do want exposure to sort of secular and explosive growth because I'm a relatively young man. But that's a small percentage of my portfolio, and I just view it as a part of it. I do have special circumstances. These are companies with, dividend growth issues such as Disney or NVIDIA or just, spin-offs and things like that. But generally speaking, in my mind, anywhere from 10 to 20% of my portfolio could be a non-dividend growth company as long as I, really like the name. But I don't separate it. I hold these shares in the same accounts that I hold my dividend growth shares in. Let's see. If you are spending dividends, are you not withdrawing the income? Well, yeah, you're withdrawing the income. You're not reinvesting the dividends in retirement if you're living off of them. But the thing is that when people talk about withdrawing, they're not talking about their income. They're talking about actually selling shares, liquidating their positions and then using those proceeds to support themselves in retirement. So yeah, my plan for me personally, and the reason I think this strategy is so great is that you don't have to sell your shares. You always have your share count. You always have your income producing assets. You don't have to touch those. You just live off of the dividends. Let's see. Do you own any BDCs? I don't, and mainly because I think there are some high quality ones. I own them in portfolios that I manage for, higher yielding portfolios for subscribers throughout our different services. And then we have, within the Wide Moat Research universe, we have a specialist in the BDC space that offers exclusive research into that area. And, I've read it, and I do find them to be interesting, and I think they can generate reliably safe high yield. It's, you know, the blue chip ones especially, but they don't generate reliable dividend growth. You know, Main Street Capital, I think, is a famous one. They do a pretty good job of raising their dividend, but a lot of them have freezes for several years, you know, maybe small cuts. But the point is, they don't raise every single year, year in and year out, like I need to see at a rate that I need to see it. So I think that BDCs can work for certain people's portfolios, especially if you're in retirement and if you need a higher yield. You know, they are generally higher risk. So, you know, you should be managing that risk with asset allocation decision making. But for me, I don't own them, but just because they don't generate the growth that I do. Let's see. You show an investment in Disney as a special circumstances. Can you elaborate on it in light of its dividend cut? That's exactly why Disney's down here. I still own a large position because I really like the company long term. I think the pandemic is like a once in a lifetime, you know, event that just impacted all of its businesses. I like Disney because it's well diversified. You've got the TV, you've got the movies, you got the theme parks, the cruise ships. Everything is, you know, a really nice package. And then the COVID-19 pandemic just crushed all of it. I don't hold that against the company. You know, I'm sure they prepare for quite a bit of, you know, headwinds, but I don't think anybody could have prepared for a global pandemic that essentially, you know, force states and the federal government to shut down your business. I simply can't hold that against management. I trimmed some shares, and then when they cut the dividend to replace it, you know, I think this was like a 6% weighting. It was one of my biggest positions coming into the pandemic. I sold some of my shares so that I could buy other dividend growth companies to replace the income that was lost when the dividend was cut. But then I just kept the rest. And because I think over the long term, I still really like Disney. I think eventually they'll start paying and increasing that dividend again. But yeah, you do notice this company is in my special circumstance category because right now it is not a dividend growth company. It's just a rare example of a company that I think is so good and that I like so much over the long term that I'm happy to own it, even though it doesn't really meet, you know, my main portfolio goal. And I guess that just goes to show there's an exception to every rule. You know, I don't think anybody can just make a you know, a true statement about the market. There's so many variables at play at all times here. You know, it's an art, it's a science. You know, there's so much going on that you know, there's no rules that are always hard and fast. Let's see. How did you decide what to sell versus? How did you decide what to sell versus what to allow as a spec in light of COVID?
Never mind. You basically answered that after I submitted it.
Yeah, no problem. Yeah, that just comes down to just personal conviction levels. So most of them I sold. I sold like UPS. I kind of regret it. You know, there's in March, you know, they signed a letter along with the airline saying that they might have to cut their dividend because of, you know, just all the issues with the logistics. So I sold my shares preemptively. Obviously, it's a mistake. Nobody's right all the time. UPS was up, you know, 15% last week, and it's well above where it was when I sold it. So you're never going to get it right all the time. But, you know, when I hear a company talking about their dividend at risk, I move on. And there's so many good ones. You know, there's greener pastures to be in. You know, I lost out on some capital gains, I guess, with that move in particular. But, you know, UPS is not really raising its dividend right now. And I think I invested in AbbVie at the time, which has a higher yield and, you know, isn't raising its dividend. So that is a good one. Let's see here. If my personal yield threshold is 6%, can I put together a portfolio that generates 6% of income, inflation adjusted forever? I think potentially, yes, you can. So you would need a 6% yield, and then you would need, you know, assuming inflation is 2% a year, a 2% annual growth. I think that's possible. Altria and British American Tobacco are two companies that do that. It's gonna be harder because of that 6% yield threshold. Probably what you're gonna have to do is create a basket of stocks. You're gonna need some 3 and 4% yielders that have, you know, 7 to 8% growth, and then maybe some 6, 7, even like an 8% yielder like British American Tobacco that has lower growth. And then your portfolio's combined yield plus growth will meet those thresholds. I do think it's possible. You know, that's getting at sort of the upper limit of what I think is likely to be safe and sustainable. But yes, I do think it's possible. What tools do you use to research individual companies? So let's see, obviously fast graphs. We went over that. Obviously the CCC list here to get all the information. I like to read analyst reports. You know, I have several brokerages with TD Ameritrade and with Merrill Edge, and formerly Scottrade with TD Ameritrade. But anyway, they give you, you know, access to S&P Capital, to Morningstar. So between those analyst reports, between free services like the CCC list and fast graphs, I have access to premium services myself as a professional analyst, FactSet portal and things like that. But I do generally find, you know, 80 to 90% of the information is publicly available and free. You know, all the company's earnings reports and conference call transcripts, those are on their IR websites. Those are also on a website like Seeking Alpha. You know, if you just, you know, type in a company here, I don't know if you guys use Seeking Alpha or not, but I think this is my internet is failing me. Anyway, you go to Seeking Alpha, you go to a company here, you click earnings, and it's going to show all their information, and you can read the transcripts, you can look at the reports. It's a lot of work, but the information is there. I also, you know, I read my colleagues' work. I think, you know, the premium services that we use that generate a lot of good information, but they do cost money per year. Like I said, depending on kind of what you need, the IDI service is $79 a year. But that's pretty basic, you know, a monthly newsletter and a weekly report. Dividend Kings, I think, is like $450 a year. That is like so much information. It's too much. It's overwhelming to me. It's overwhelming to a lot of people. But if you really just love data, it's all there, you know, for $450. So basically there are, you know, services that you can subscribe to that provide a lot of dividend growth specific information, but you know, the companies provide it all for free. And I'm assuming your brokerages offer you research for free as well. Okay, so that's everything. I mean, if anybody has any more, I'm happy to stick around, but if not, you know, I can pass it back to Andy. And you know.
Yeah, Nick, I noticed that in your portfolio you had IBM, and I've been kicking the tires on it myself. And you know, it looks like to me that they still haven't quite turned the corner yet. You know what I mean? And
yeah, well, actually, I'll quickly interrupt you here. I sold IBM about a week ago.
Oh, you did? Okay.
Because this is my March update. I haven't published the April one yet.
Okay.
That's why. They just announced their dividend increase at 0.6%. So it's a high yield company. And, you know, so I think, you know, the roughly 5% yield, or they've rallied now. So it's probably like what, 4.5%. I think the yield's safe. It's well covered by earnings, but that 0.6% growth rate, it doesn't meet the inflation rate, which is basically like my low end requirement. So when that happened, you know, somebody asked what's a sell signal for me. A disappointing dividend increase can be a sell signal. IBM, in my point of view, you know, isn't really meeting my goals any longer. So I sold it. I bought shares of Pinnacle West Corporation. That's a
utility, isn't it?
Yeah, utility that operates in Arizona. I bought shares of British American Tobacco, and then I bought shares of Realty Income. So using the proceeds from my IBM sale, I actually increased my passive income by 22.5%. And I think it has better dividend growth prospects moving forward. So I don't like to trade actively. I think buying and holding is generally, you know, the way to go. But, you know, you bring up IBM, that dividend increase was, you know, it was just a disappointment for me. I think the company can turn itself around. I like the CEO. I didn't like the previous management team, but at this point, you know, it wasn't, you know, meeting my goals any longer.
Well, good. Thanks. Any more questions for Nick? Well, this has been fantastic. Wow. Nick, your newsletter is you said $79, I guess. Is that what you said?
Yeah. Yep. I think, you know, it works out to like, you know, $6.75 a month. I think you know, we said it's one cup of coffee a month pretty much. So that's, it's our front end. The front end is more, you're welcome, William. Thank you. You know, we view it as a front end product. Our business model is sort of like front end is simple. It's basic. It's easy to understand. And then we have back end products that are more expensive if you think you need more. So, we do have another question, which I'll address in a second, but yeah, so IDI is only 79. And then if you have that, you know, you get the portfolio, you get all the research, but you only get research that's specific to that portfolio. Whereas our other services offer research on hundreds of companies. let's see, Jack Glasser said, what about Philip Morris? I think it's a high quality company. Let's see, my internet was kind of broken just a second ago. So let me see if this works here. The reason that it has higher growth than both Altria and BTI because it's the leader in the heated tobacco space, which is kind of where these companies are trying to go. That's deemed to be safer. As you see here, look, Philip Morris is expected to post double-digit growth essentially in the next 3 years. Wonderful. That supports its dividend very well. The problem is it's trading for 17.5 times earnings, and that's above its long-term average. So I'm sticking with Altria and BTI because they're so much cheaper. And but Philip Morris, I think, probably offers a slightly safer dividend yield at this point in time. It is lower. It's only 5% as opposed to 7%. But I think it's a great company. So if you own Philip Morris, congratulations. And I'm sure this will be generating not only strong passive income, but likely total returns for you for many years to come.
Any other questions for Nick? Well, okay, I guess I think if you can release your screen, I'll
oh yeah, let me stop share.
Okay.
Does that work?
Yep. All righty, and then I will do my thing here.
All right, cool. I'll go on mute. But guys, thanks for having me. Like I said, it was an honor. And if you have any questions, just direct an email at me through our support at Wide Moat Research, and I will get back in touch with you.
Thank you very, very much. Let's see if I can get this thing to, yeah. So yeah, thanks very much, Nick. I really appreciate you taking the time. I know Sundays is probably your rest day, and so taking the time to do something like this is really, really appreciated. And I'm sure everybody in our group will find this to their advantage. We will have a recording of this available later on this week, and I'll send you a link to it. And so if you want to forward it to your clients or to your prospects, feel free to do that. It'll be available on our public site. So, okay, just to thank again Nick for his help. For the rest of you, we're looking for prospective speakers, and so please shoot me your ideas. You can either post it on the Google Group site or just send it to the link shown here. And between meetings, by all means, don't hesitate to use the Google Group for your activities, your questions and comments. I saw where Sean posted something that was interesting to me that I'm going to do some homework on. So by all means, if you come across a website that looks interesting, post the link. It might be advantageous for us to all look at it. Okay, so our next meeting will be June the 6th, and that will be the one that we're hoping to have our friends at the Computerized Investing Silicon Valley chapter talk to us. And I'm looking forward to seeing you. You'll get a notice from me when we have more information about the details. And we'll see you next time and June the 6th, and keep posting to the Google group. Bye to everybody. Bye-bye.